Hey, my name's Rajesh. I'm a direct lender based in Los Angeles and I specialize in vacant land. Today we're going to discuss different ways to finance vacant land. But first, we're going to start off with a few definitions. There are basically three reasons why someone would want uh, to finance vacant land. They're either purchasing it or acquiring land that you do not currently own, refinancing it. This is when you are replacing your existing loan because you want better terms or you just need more time because your loan is coming due and you do not want to extend with the current lender, or maybe your current lender is just not letting you extend. Then there is cashing out. This is pulling equity out of land you currently own. And there are three ways to do this. There's land loans, which allow you to do all three: purchase, refinance, and cash out. There's construction loans, which allows you to build something on the land. And then there is other, using other sources to get the required cash. With land loans, we basically break it down into residential and non-residential. And within residential, there's 1 to 4 units, 5+ units, and non-residential is stuff like agricultural land that is being used for commercial purposes. This is different from having a homestead where you are just growing a garden or growing crops for personal use. So it's producing money. It's not about acreage. It's about how you're using the land. Um, if you're using it for commercial purposes or recreational purposes, such as for hunting, or it's even if it's going to be used for a building, but it's not zoned residential, then it would be considered non-residential land. With construction loans, there is again residential and not and non-residential. Non-residential would be, building a hotel, building an office space, building um, a warehouse, building a restaurant, things like that. Within residential, there's 1 to 4 units and 5+ units. 5+ units is considered commercial. And then here are the other sources that can give you the cash that you need to either purchase the land or pay off the existing loan, or with better terms, assuming these options provide better terms than your current financing, or if you just need cash and you don't really care where you get it from. So there are personal loans, there's business lines of credit, and there's pulling cash out of other REO or real estate owned. And we'll go over each of these options right now. So with land loans for purchase, as a direct lender, this is what I can do in-house. I can go up to 65% of the purchase price or value when purchasing or refinancing. So let's say a property costs $1 million. I can provide up to 65% or $650,000 for that purchase. If you're refinancing it, let's say you have $1 million property, your current loan balance is 600,000, 620,000. We can go up to $650,000, roll up all the fees, and get you the time that you need so that you can take your time paying back that financing. Um, the terms are generally 10 to 15% interest rates and 20 years fully amortized. I keep doing this where I forget to add the Y after fully because in my mind I see the two L's, and yeah, I can't explain it logically. I can't. But I keep forgetting to put the Y after full and fully amortized. Uh, that's on purchases and refinance, rate and term refinances. So let's say you own a piece of property, seller financing's coming due. They may extend it for 6 months, they may extend it for a year, but you still owe like $200,000, $300,000. No way you're paying that off without either pulling out that much cash from somewhere else or just refinancing that into a longer term, or selling the land. Um, On cash outs, I can go as high as 60% LTV or $1.2 million, whichever is lower. So let's say you own a $2 million piece of land. 60% of that would be roughly $1.2 million. So in that case, they coincide, they are equal to each other. So I would be able to get you $1.2 million from that piece of land that's worth $2 million. But let's say that land is worth $10 million. Your max cash out is still going to be limited to $1.2 million because $1.2 million is less than 60% of $10 million or $6 million. This is a stated income program. Yeah, we can qualify you using full doc or tax returns or W-2s or Social Security income. And if you have that, great. But and you'll get better rates. But let's say you're a business owner, you're self-employed, or you're an independent contractor, and on your tax returns you're showing losses. So on your P&L program, provided it's signed by a licensed tax preparer, CTEC or CPA, we can allow you to provide a P&L or profit and loss statement instead. Minimum FICO for our program in-house is 680 or 680 credit score from TransUnion. So you could have 800 credit scores on Equifax and Experience, but if your TransUnion's credit score is below 680, we're not going to be able to do the deal. Interest rates, again, between 10 to 15%, and this is 20 years fully amortized. On a construction loan, so let's say you're buying a piece of land or you own a piece of land, your loan's coming due, but you've finished entitlements, you're ready to build within the next X days, 60 days, 2 months, 2 to 3 months, 30 days, whatever it is. We will be able to do a construction loan because you can get better terms on that. And since you're planning to build anyway, it doesn't make sense to do the land loan. So if you're doing a piece of property that's owner occupied or will be owner occupied, so let's say you're building a home and that you're going to live in it, we can go as high as 95% LTC. What that means is, let's say the total purchase price of the land and construction is $1 million. We can go as high as $950,000, which means you're only putting $50,000 down. If you already own the land, on this particular project, we will discount the value of the land completely. We will discount what you've already spent on it. Only thing we're really going to look at is the total construction cost. And let's say the home will be worth $1 million, the land costs $200,000, and it's going to cost $800,000 to build. You will be putting 5% down of that $800,000. This is a OTC or one-time close loan, which means that it's interest only during the construction phase, and after you finish construction, you do not need to refinance to pay off the construction portion of the loan. It just turns into a fully amortized loan over the remaining 29 years. So it's a 30-year loan. First year is interest only. Remaining 29 years is fully amortized, and your interest rates are usually between 6 to 9%. During the construction portion, it's higher. And then after construction, after the home has passed inspections and it's fully approved, then it floats down into whatever the market rate is. So if market rates at the time of finishing construction are 3%, you would get a 3% interest rate. If they're 5%, you would get a 5% interest rate, regardless of what your interest rate was during the construction portion. And during the construction portion, you're only paying interest on what you actually use. So let's say you budgeted $800,000 for construction, but you only used $500,000. So your monthly payments would be 9% or whatever your interest rate is on that $500,000. First month, you've only used maybe $50,000, so you're paying 9% on that $50,000. That's how it works. You only pay interest on what you use. The kicker here, the string here is that you have to start construction within 60 days of closing. And again, this is for owner-occupied properties. The other way to get financing for purchasing a land or purchasing a parcel, paying off the existing lender, or pulling cash out is, with personal loans, you can get longer terms, and not just personal loans, but also business lines of credit. 0% interest, as low as 0% interest. Some will have higher interest rates, some will be towards the lower edge, and some will truly be 0%. This counts as 100% financing because, and I put that in quotes, because let's say you're buying a $50,000 piece of land, $15,000 piece of land. We can get you lines of credit, and this is a broker deal right here. So we don't do this in-house, but through our lending connections and networks, we can, get you lines of credit and personal loans up to $350,000. So if the land that you're looking, or loan that you're looking to pay off, or the cash out that you need is less than that, that is 100% financing. So let's say the piece of land you want is $20,000, we get you a $20,000 loan, you're putting $0 out of pocket. This may require proof of income, and you generally have to have a 680 credit score or higher, and you have to already have high credit limits. So if your existing credit limit is $100, this is next to useless for you. If your existing credit limit is $3,000, if the piece of land you're buying is less than $3,000, fantastic. If it's more than that, it would not be 100% financing. But it may be enough. If you're buying a $5,000 piece of land, you have $2,000 cash, maybe you have $10,000 cash, but you don't want to blow it, half of it buying the land, a $3,000 loan may be good enough, because now you're just using $2,000 of your own money to buy it. That would be about 60%. On our land loans, our minimum loan amount is $150,000. That means the purchase price, the minimum purchase price, has to be $150,000 divided by 0.65, or $230,000. Let's just round that up to $231,000. So if the purchase price is less than $231,000, this land loan is not right for you. If the value of the land that you currently own is less than $231,000, this loan is not right for you. Let's see, what else can I say? And this is for, commercial properties. So this would include residential 5+ units and non-residential properties. So we are looking at up to 65% LTV for purchase and refinance. This is mainly for land that will eventually be constructed on. Let's say you're still entitling it, still mapping it, still getting permits. This is where this would fall. Cash out wise, and even purchase and rate and term refinance on just plain recreational land and non-construction based land, we're looking at somewhere between 25 to 50% LTV for the cash out purchase or refinance. These are more hard money side, no income. 680 FICO is probably on the low side. I would say it's closer to 700 FICO for commercial construction projects, and maybe 0 or 580 FICO, 580 credit score on the hard money side, because it is vacant land. You're looking at interest rates between 12 to 17%, and these are generally terms of 12 months with interest only payments. We do not do these in-house. We broker these out to our various lenders in our network, connections that I have made over time because of specializing in this field. When it comes to construction loans on investment properties, we can go as high as 90% LTC, but these are generally for 1 to 4 units. If you're doing a 5+ unit building, if you're building a restaurant, if you're building an office space, we're generally looking at 75% LTC. I should make an addendum here. It should be or 75% AR LTV. What that means is we also look at the after repair value. So we may go as high as 90% LTC. So let's say it's $1 million project and it costs let's say the total cost is $1 million, including purchase of the land or if you already own it. And on these ones, we will include the value of the land. So let's say you own a piece of land for $200,000. Total cost is $1 million. We'll give you $200,000 credit towards that. So you're only looking at a total cost of $800,000. We will deduct that from that total cost. So let me see a way to make this make sense. Let's see how I can simplify that. So total cost is $1 million. You've already spent, and we'll go as high as 90% LTC, which means we will do a loan amount of as much as $900,000, meaning you have to put in at least $100,000. But if you've already bought a piece of land that has a value of $200,000, either because you spent cash on it, spent $200,000 cash purchasing it, or you bought it 10 years ago, over time it's appreciated, or you bought it for $50,000, you've done a lot of horizontal work on it already, and now the value is $200,000. You're essentially coming into closing with zero cost. You've already come in with $200,000 towards the land, so you're going to get, you're not going to have to put in 10% of the $800,000 construction. We're going to credit you that $200,000 towards the down payment, towards your equity injection. This sell refinance, this is how you get out of a loan, because it's not for owner occupied. You're not going to be living in there after you finish building it. So when it comes to paying off this loan after the term expires, how are you going to pay this off? You're either going to sell the property or you're going to rate and term refinance it into a rental property, into an investment property that you're going to rent out. So these are exit strategies. And our minimum on this is a 660 FICO. And you're looking at between 9 to 13% as far as interest rates go. And your term can be between 12 to 36 months, interest only. Non-Dutch interest, which means that you're only paying interest on the portion that you use. So this is our general terms for construction loans that we do for 1 to 4 units. Now for commercial buildings, and that means 5+ units, we're looking at 75% loan to cost or 65% AR LTV. And we will use the lower of these two amounts. Even when doing 1 to 4 units, we will still use the lower of these two amounts. So using the $1 million example, if we were to go 1 million divided by 0.75, that tells us that it has to have an after repair value or a finished value of 1.33 million at minimum in order to get the full $900,000 loan amount. Anything less than that, and you're only getting 75% of the after repair value. So let's say it costs $1 million, the after repair value is $1 million, and that means your maximum loan amount is going to be $200 or $750,000. So let's say you do not want to build on it, you don't like the terms of the land loans because you don't qualify for the in-house financing. And again, this is for residential land 1 to 4 units. So you may have land that's qualified for 5+ units, or land that is qualified for, or it's not residential. It may be industrial land. It may be commercial land. It may be agricultural land that's used for commerce purposes. Meaning you're not just having a personal garden on there, you're growing and selling crops on there, or cattle or whatever. but and for this one, we would be fine with cattle on there as long as it's owner occupied, such as a homestead or something. Um, but if it's not, then we are looking at, you know, other options here, which may be a uh, the way to do this would be to pull cash out of existing real estate. So let's say you have a large real estate portfolio that's not vacant land, maybe it's a rental property or your primary residence or something. We can get you better terms, we can get you better rates than either of these two options combined. And depending on how much equity you have in your existing real estate portfolio, we might be able to fund 100% of the deal. And depending on whether it's first or second position, meaning let's say you have a 3% interest rate on your property, there's no way in hell I would recommend touching that, but we can put a loan behind it, sort of like a HELOC, that does not touch this loan and leaves it alone, but now you have a second loan after it, and that might have a slightly higher interest rate, but it'll probably be in the sevens or eights. And depending on your tax type, so let's say you're W-2, you're earning $700,000 a year, and your total debt to income ratio is maybe 10 to 15%. So getting you enough cash on to fund a construction or to pay off an existing loan is not too unrealistic. And if we have to go hard money, there's no minimum FICO required. If we're but then the interest rates are obviously higher, but it's doable because you don't qualify for this anyway. And depending on how badly you need this money, that may be the way to go. Some of these loans will require proof of income. So if we're going, full doc like a HELOC or a HE loan, that will require proof of income. If we're going hard money and we got to close in 2 weeks, even if you have great income or you have a great credit score, but the time to close is of the essence. You need money in 48 hours, you need it in 2 weeks. We can do this. It's going to be higher interest rates, but it's going to be considered private money or hard money. So those are the different ways that we can get you money. These are the most common questions I field from clients while on calls, and I figured by making this video, I can paint out and anticipate some of your questions so that you can really think about what you want to do before we speak, so that we can be much more productive on our calls. Anyway, until next time, good talking to you.